بسم الله الرحمن الرحيم والصلاة والسلام على رسول الكريم. السلام عليكم ورحمة الله تعالى وبركاته. Welcome to Takaful online class. And today we carry on the discussions on the main differences between Takaful and insurance. And we are at the point number 10. And the point number 10 is basically talking about the payments and the contributions, or known as well as the premium. So in the conventional insurance, the premium basically, or the amount paid, which is known as the premium, it creates a kind of obligations against the insurer on sale and purchase contract. So because it is a kind of sale and purchase contract, so it does create an obligations because of the money paid, which is regarded in a form of a price in the contract of purchase. And from the insurance standpoint, it is a product also in a form of policy that has been sold to the participant or to the policy holder. So there is a kind of transactions, there is a kind of buying and selling, but the premium or that kind of contribution will create a kind of obligations on the company or the insurance company. Now, for the Takaful, that kind of contributions, that kind of donations doesn't create any kind of obligations on the Takaful operator. Why? Because the donations or the contributions, or known in the convention as the premium, given by the policyholder or by the contribution, is regarded as a donation. And you know, when you donate something, it doesn't create any obligation from the other party because you are not buying something. If you buy something and you pay money, so it creates an obligations for the sales contract, the other one to deliver something. But the Takaful, the contributions given, the money given by the participant, doesn't create any kind of commitment or obligations or responsibility as far as the amount given to the poor. Meaning there is no kind of commitment to give something. But that kind of commitment and responsibility and mandate of the Takaful operator to, of course, to manage the funds, to administer the fund, to invest the fund, to compensate the participant, is not as a result of the contributions given, but that one as a result of the contract of wakala that has been established between the participant and the Takaful operator. Meaning that there is a kind of wakala or agency contract between the Takaful operator and the participants. Based on that contract, the Takaful operator has been appointed as agent to manage the affairs of the participant on their behalf. So that's the commitment, that's the mandate, that's the obligations, not the obligation as a result of the money given to the poor, which is a bit different than the insurance company. As the insurance company, the obligation is created as a result of the premiums paid by the participant. And as a result of that also, we have to understand that, we have mentioned it many times also, that the money given by the participant is not a kind of purchase to something, but it is a donation. It is a kind of tabarru. Of course, we will come, when we come to the underlying Sharia contract discussions, we'll talk about the tabarru and the contract and the other related contracting details. But this one, because we are just highlighting in the previous series of sessions, we highlight the terminology, which is a high-level description. And for this series, we are talking about the differences. But we have coming sessions that talk about the underlying Sharia contract, where we dive in a literal meaning, a technical meaning, and some Sharia context and requirements and applications on those contracts, like, for example, tabarru, donations, waqaf, wakala, and mudaraba, and other related Sharia compliance contract pertaining to Takaful. So again, at the high level description, again, we may say that The money given, it doesn't create any obligation because it is regarded as a kind of contributions, a kind of donation, is a kind of tabarru, and the commitments and the obligations has been created from a different contract, which is the wakala. The item number 11 that create a line of differences between, again, takaful and insurance is basically the ownership of the fund. The ownership of the fund in the insurance company, it is of course owned by the company. So why? Because again, and we go back to the business model, to the underlying contract that governs the insurance is a buying and selling. It is an exchange contract whereby the contributor or the policyholder will give a premium, and that premium is regarded as a price, which creates an obligations from the insurance to deliver something against that. So the money given goes to the pocket of the shareholders, so it is owned by the company. But when it comes to the takaful operator doesn't own that premium, doesn't own that contributions. Why? Because it is a donations to a pool of funds, which is held in trust by the takaful operators to manage it on their behalf for their interests. So again, we go back to the same point that has been highlighted before. The takaful operator, its position is as wakil, is as an agent to manage the fund, and he doesn't own that fund, but that fund collectively owned by the policyholder and by the participant. What the takaful operators or the shareholders own is basically the fee of the wakala. As you know, one of the source of the income of the takaful operator is the fee of the wakala. It varies from takaful operator to another. Sometimes it is 25%, 30%, 35%. Internationally, you may see some 50% of the commission. So it may vary from country to country whether the regulator manage or restrict the commissions, buffer and put a limit to it. In some countries they may not. So it goes back to different practices. But the average, we are talking about 35%, 30% to 40%, or even to 45 and 50%. So that's the income. That's the income of the takaful operator, which means that what comes to the pocket of the shareholders of the takaful operator is the commission from the contributions. It goes to the pocket of the takaful operator, and the balance goes to the fund, and he will be appointed as wakil to manage that fund on behalf of them, and he will be paid that kind of a fee, wakala fee, for that kind of management, or agency fee for that kind of management. So again, when it comes to the insurance, 100% the contributions or the premium goes to the pocket of the shareholders, and as a result of that, the funds is owned by the shareholder, even though it is regulated by some rules and guidelines of standard of the central bank. But when it comes to the takaful operators, the commissions goes back to the pocket of the shareholders, of the takaful operators, and the balance will goes back to the fund. So the fund is not owned by the takaful operator, but it is managed by the takaful operator and owned by the policyholder. We stop here, and we carry on the remaining differences between takaful and insurance in the coming session. With that, thank you very much, and assalamu alaikum wa rahmatullahi ta'ala wa barakatuh.